Welcome to another weekly Friday chat. This week we're going to have an educational piece and kind of go over how treasuries work, the interest rates, when it makes sense to purchase. Let's go. All right, so where we are right now with interest rates, and we have an inverted yield curve, which we've discussed ad nauseum. But right now, treasuries, and with the 10 interest rate hikes, although we had a pause with the last one, short-term treasuries, you can get yields of about 5.3% for stuff maturing in less than 1 year. So I wanted to jump through them and give you an idea of what they are, how they work, and when they're appropriate to use. So very simply, what is a treasury? It is a U.S. debt obligation that's issued by, you guessed it, at the U.S. Treasury Department. And it's backed by the Treasury Department. So it is widely known as one of the safest risk-free investments that you could purchase. Typically, though, the short-term treasuries yield very, very little. Right now, because of the phenomenon that we're in, we're able to get, 5 to 5.3% on, we're doing a lot of like 3 and 12-month stuff, but you can do 1 month, a lot of different things. So I kind of wanted to jump into that and just kind of give you that framework. So there are 3 different types of treasuries, which has to do with when they mature, their maturity lengths. So the 3 of them are, you have T-bills, which basically mature up to 1 year, so 1 year or less. You have treasury notes, which mature in 2 to 10 years. And then you have treasury bonds, which typically mature in 20 or 30 years. Now, when we say mature means when you purchase a bond has a maturity date, which says, okay, if I'm purchasing $1,000 worth of a bond and I'm getting a 5% interest, if my maturity date is August 1st of 2023, then I will get that $1,000 that I gave to the Treasury to purchase the bond back on August 1st of 2023. If I have a maturity date of August 1st of 2030, well, that means I'm going to be getting interest payments from now until when that bond matures on August in 2030. So you will have received all of the interest payments, and then you would receive your principal back. So those are the 3 main types of bonds. You have T-bills, which is what you probably hear most of, T-notes and T-bonds. They're kind of used interchangeably, but they do have different distinctions based on when they mature. They also do have a good tax favorable feature to them.
These daily games are costing a fortune, yet we have no new taxes.
They are federally taxable, so any interest earned, you're paying taxes on, but they are state and local tax exempt. So you do get a state and local tax exemption there if you are in a state where you have state and local taxes. They're typically issued in $1,000 denominations. So what that means is if I want to purchase $50,000 of a T-bill that's maturing in 3 months, I would purchase 50 bonds. 50 bonds times 1,000 equals 50,000. So that's kind of how it works. They're purchased in $1,000 denominations. They are interest rate sensitive. So if you give them $1,000, right, and then it matures on the same example, August 1st, the market value will fluctuate based on the current interest rate environment. So if interest rates are rising, your bond price, your treasury will be worth a little bit less. So the longer bonds that you have, let's say you bought treasury bonds that matured in 30 years, there's a lot more interest rate sensitivity risk than bonds that you would have purchased, that a T-bill that would have purchased in, let's say, 3 months. And the reason is something called duration risk. What duration risk measures is for every 1% change in interest rates represents approximately for every 1% decrease in your bond price, or vice versa. For every 1% decrease in interest rates will represent a 1% bond increase. But let's just take it, I'm on the negative side because that's what we do in life.
Just think positive. Never let a doubt enter your mind.
But if you're looking at a 1% increase, right, for every year, so if you have, let's check out this chart right here from BlackRock, which I think is great, which kind of tells you, okay, if you're looking at 2 years, if you have a bond that matures in 2 years and your interest rates go up 1%, well, you're going to have an approximately 2% decrease in your bond value. That's what duration means. If you have a 4-year bond, interest rates go up 1%, you're going to have about a 4% increase. 6 years, again, a 1% rise. It's not a 6% rise in interest rates, it's 1%. But as you keep going longer on the maturity curve, your interest rate risk and sensitivity increases. That's what happened in 2022. That's why we had one of the probably the worst bond market we've ever had, or at least since like the 1850s. So that's really what it means. So when you're purchasing bonds and you're looking to sell them early, the shorter the maturity, the shorter until it matures, the less interest rate risk and less of a big deal that, you'll basically make out either way. If you have longer notes or bonds that are maturing in 10, 15, 20 years, what have you, selling before it matures could result in substantial losses or substantial gains. Okay, so when should we use these? Well, right now, what I'm doing with a lot of clients is we're using these as cash alternatives. I mean, if we know we're not going to have to use money, or we have money in savings accounts tied up, now savings accounts and high yield checking accounts, money market accounts are probably yielding right around 4.5% to 5%. But what we're doing a lot of is, again, cash alternatives, where we've got funds that are earmarked for emergency funds, nothing that we need right away. So we're kind of buying 3-month, 12-month treasuries in order to do so. And it's working out really well. The other way to use them is sometimes it makes sense if you've got money on the sidelines and we're investing or we're making changes to our investment accounts, it makes sense to kind of fill out right now with short-term treasuries for our bond portions of it. Because right now, it's hard to pass up that 5% yield. Where it becomes kind of tricky is if we had bonds prior to 2022, it doesn't make sense to kind of swap those for the high yielding treasuries, because the principal that we would lose, or the price being down so much from the past year and a half, doesn't mathematically, it doesn't work out. Another common question that I get from a lot of folks is, do these pay interest? When do they pay? How do they pay? And those are great questions. So there's, again, remember we talked about T-bills, T-notes, and T-bonds. The T-bills that mature in basically anywhere from 1 day up to 1 year, those do not pay interest. Those are issued at a discount. So typically bonds are traded what they call at par, which represents 100, which equals dollar for dollar, right? So 100 equals dollar for dollar. If I'm buying 10 bonds, $10,000 worth at par at 100, I'm purchasing it for 10,000. If I'm purchasing the same thing, but now we're talking about T-bills, if I'm purchasing those same 10 bonds for $10,000 worth of, they will be trading below par at what we call spot point or 0.995, let's say. So you would only be giving them, let's say, $9,950. Then the difference between that $9,950 and the $1,000 that it matures at is what is called your yield to maturity. That is your interest. So when you're purchasing these, anything, a T-bill that matures in 1 year or less, you will be purchasing at a discount predominantly, and there's no interest payments. T-notes and T-bonds issue interest payments every 6 months. So depending on the issue of the bond, that's when the interest payments will be made, and it's basically made twice a year up until maturity. So for notes and bonds, you can expect interest payments twice a year for that. Those could be traded at par, at a premium, at a discount. So par, again, is dollar for dollar. A premium means you're paying more than $1 per bond, and the discount means you're paying less than $1 per bond. So when you're looking at bonds have what they call coupon rates or interest rates. The interest rate that a bond is paying, if a bond is paying 5% and it's trading at par, your yield to maturity, which measures your actual yield, because you have to remember, if you're paying more for a bond, your yield to maturity is less. And if you're paying less for a bond, your yield to maturity is higher than the coupon. So if, again, take that 5%. If it's trading at par, your yield to maturity is 5. If it's trading at a discount and the coupon, which means the interest payments that you'll receive, is trading at a discount, your yield to maturity will actually be higher. It could be 5.1, 5.2, 5.3. If it's trading at a premium, your yield to maturity will be lower than the 5%. Could be 4.5, could be 4.6, could be 4.8. So that's kind of how the interest payments and that stuff works, and also, purchasing it. Again, T-bills, when you're purchasing them at a discount, and whatever the bond matures minus what you paid, that's your interest, that's your yield. Also keep in mind too, if you're purchasing a 3-month T-bill right now at about 5.3%, let's say, you are getting a 5.3% effective yield for 3 months. But when you're talking about yields and interest rates, they're referring to it on a 12-month calendar. So 5.3 over 3 months is not really a 5.3% rate of return for those 3 months. It's actually not it at all. So if you only purchased it for 3 months and then took the money and put it elsewhere, you actually yielded about 1.3%. If you rolled it, so in order to realize that 5.3, you would have to every 3 months purchase a new T-bill for that same 5.3% for a calendar year to realize a total effective 5.3 yield. All right, that's it. Another weekly Friday chat is in the books. Educational style, Treasury, bills, bonds, and notes. I'm going to give a quiz the next time we talk. If you know the difference between a bill, a note, and a bond, I'll know you stayed till the end. So, hope everyone had a great week, is going to have a great weekend. If you can like the video, that'd be awesome. If the more likes we get, the better I feel, which is always good. And remember, Fridays are for pizza. You know it. Let's do it. See ya.